I'm ready to go. I see the time. Just a few seconds. Just a few seconds. Hello, everybody. Let me see. Let me make sure that sound is good. Welcome, everyone, to the session. Today is March 13, 2023. This is our SMARTT Tiger Live session. And happy, as always, normally we meet a couple of times a month. Happy to, as always, to look at the markets, to go over what's happening out there. Lots of things to discuss today, by the way, but also happy to look into market opportunities. I have a few ideas I would like to share with you today, and we'll be talking about it, and hopefully the session becomes very rich when it comes to trading, when it comes to practicing, when it comes to understanding options trading, and all of the above. My name is Jose Blasco. You can see my contact information on the screen. You can see our social media handles. So please go ahead and follow us and like us and all of the above. And before we get started, on the upper left side of the screen, you can see our financial disclaimer, which is being highlighted little by little. So please read it carefully because it is important information. As we are starting the session as well, I just want you to know, guys, that I see you. I am watching the chat box both on YouTube as well as on the Tiger Live or the Tiger Brokers mobile app. And in that sense, I would love it if you guys could utilize the chat box to interact with me, either if I have questions for you or if you have questions for me. You can certainly communicate in an efficient way. And I would love to see and confirm all is good by requesting, please, a quick hello message on the chat box. That would be kind of you. That would be nice for me to see the chat box is working, and also to see that you are happy and ready to interact. I would not want this session to be a monologue, even though, of course, I will be leading it, but for sure, I would certainly appreciate your interaction. So please type hello on the chat box so I can see you. As you are typing hello, I would like to mention a bit about the agenda for today. So I'll go over some quick introductions. I won't spend too much time on that. We'll talk about headlines. That has a lot to do with understanding what's happening in the market today. But beyond the headlines, we will then get into the special market commentary. So that's really when we will understand what's going on in the market. In the meantime, we'll also look at some opportunities to place a few orders. Of course, placing the orders with real money or paper money, a large size or a small size, all of those is going to be your decision, as you read on the disclaimer. My plan, my approach is educational, if you wish. It's for practice purposes. Again, executing the trades with real capital or not, or even executing the trades at all of this is your decisions. And for sure, feel free to ask questions if you have, so I can give you more details about the mechanics of options trading. So that way you are in a more confident position when you do your executions. I have a bonus for you, which I'll mention later on. But as we start, I wanted to start talking about a new options commission plan that has been set recently with Tiger Brokers, where apart from having the classical fixed commission plan where you pay per contract, there is also a tiered commission plan that works as follows. So this plan is by keeping in mind active traders. So again, the more you trade, the less you pay per contract. And this table, I think, does a great job at representing that very clearly. So up to 50 contracts is 80 cents. If you do 2,000 contracts a month, then it's 50 cents. Again, there are more details in the table, as you can read yourself, okay? Keep that in mind. The fixed plan, you probably know it already. It's as described on the screen. And again, while it's great if you are less active as a trader, again, if you are more active, you will probably appreciate better the tiered commission model, okay? Great. So the question is, how do you switch from one plan to the other plan? You would do this with the mobile app. You would simply go ahead and go to portfolio on the app, and then you would click on more, and then you would tap on pricing plan, which is this. And the moment you tap on pricing plan, now you can either select tiered or fixed. Okay, here on the top, it tells you what plan you have and what will you have next month. Okay, and once you have selected the one you want next, then you click apply now, and that's it. Okay, so it's very simple for you to switch from one plan to the other, and you can actually alternate as well if needed. Okay, cool. Anyway, so introductions. My name is Jose Blasco. I said it at the beginning. I am a multi-asset trader. I trade all assets. Options is my favorite. I love options, and therefore, in today's session, I will be using options, not only from a trading opportunity point of view, but also from a market analysis point of view. Most market analysts, when they do their market analysis, they look at the charts, which gives you information about the markets that you trade, which is great. But apart from doing that, which, by the way, I will do this with intelligent trading technology, apart from that, I will actually look at options data that reveals information about the markets that we will not see on a chart. So you will see me do that later. You will understand better when I do it. Our company is tradewithufos.com, so you can find more about what we do in the company using our website, tradewithufos.com. You may be thinking, UFOs, what is that? Well, UFOs means on-field orders to buy or sell. Green when it's buy, red when it's sell, and they look like flying saucers on the screen, so we call them UFOs. But again, it's not coming from another space, it's not coming from another planet, it's actually in the financial markets, and this is the force responsible for market movement. When orders that were on field get filled, that's how the markets move in a specific direction, or that's how the markets are attracted to reach a specific price point. So we love to use the UFOs for entries and exits. And you could be a purist, and that's the only thing you do. You use the UFOs and that's it. Or you could combine it with other methods. Maybe you do value investing and you use the UFOs. Maybe you are a Fibonacci trader and you use the UFOs combined. You name it. Okay, but anyway, I said I would keep short our introduction, so let's keep going. Headlines. So what's happening out there in the world? Most importantly, what is likely going to impact the market? Because we could talk about things forever. Most of the news that are publicly announced out there, they have no to little impact in the markets, but some of the news are more impactful. So I am very pragmatic, in case you have not been in my sessions before. So keep that in mind, because I'm just focusing on what matters the most. So I'm not going to be original. I'm not going to be bringing things to the screen that are going to be like, oh my God. No, that's probably for BBC and channels of that sort, with all respects. But in my case, I'm thinking like a trader, so I'm not thinking like a journalist, and therefore I'm looking at really matters when it comes to things that could happen in the market. So we've got Russia, Ukraine, and the US-China tensions. What does that mean? To be honest, nothing, but at the same time, it is the source for any moment in time that something happens. Maybe some decision is taken around Taiwan, some decision is taken around North Korea, and maybe China or the US says something about it. Maybe something happens in Europe, especially with Ukraine and Russia, and next thing you know, the markets react to it. So these are news that are there for a while. These are news that are likely going to be there for a while, but we cannot forget they are there. Okay, that's a mistake that many traders make, because it's they don't talk about Ukraine so much like what they used to do 1 year ago. So next thing you know, we forget. Well, we cannot forget, because those are factors that imply risk and opportunity both, and we should be on top of this if anything was to happen in those domains. The US fighting inflation is also something that's happening for a long time. So you may say, oh, not a big deal. Well, yes, it is a big deal. Why? Because later this week, the CPI will be reported. So, again, we may have market reactions because it's a very hot topic in the marketplace. But on top of that, you may be aware, and if you're not, there are certain banks in the US that are now showing trouble, especially Silicon Valley Bank, SVB, showing a lot of trouble, is being intervened. The FDIC took over, a little bit of a mess. Another bank in New York is also, in a similar situation. Now, why is that happening? Why do we see problems with the banks? Again, who knows? I guess every bank will be a little bit of a different story, but there is something which applies to all of them, and is certainly related to item number 2, which is the inflation. So what the Fed has done to fight inflation is to raise the interest rates. And as the interest rates have been risen, loans became more expensive, and some companies may not have cash to pay back for the loans, putting certain banks in trouble. So you have the Fed trying to fix the economy, and maybe they create other problems they didn't think of, or they had to take the risk, or whatever it is. But the fact is that we are in a situation where there is a lot of fear in the marketplace right now. I will show you options data later that shows that very well. So it is a very important element in the markets starting last week, and certainly to be watched as inflation numbers are reported this week and so on, because certainly we have two names right now, two banks that are in trouble. I would say it's probably going to be way more than two. And if in the case of SBB, for example, there are so many companies involved, most of them are startups. So we may see a great impact also on unemployment numbers a couple of months from now. So something to really keep an eye on it. It could be such a big thing happening in the rest of 2023. And maybe it's just a little bit of a scare and it's going to be an isolated event, couple of banks, and that's it. But again, given the fact that to me, this has a lot to do with the fact that the Fed has been increasing interest rates. So probably this is just the beginning of a little bit of a nightmare for certain banks, and maybe even in the marketplace if you are long only, okay? If you're going to be shorting, not a problem. Or if you're going to go long by using options, as I will show later on, could be very nice as well. But certainly for the people that are buying and holding and just focusing on, let's say, value investing, hoping for the best because your stock is good, well, it's not about the stock is good or bad. It's about what else is happening in the marketplace, in the sectors, in the industries, which are going to impact what is going to happen out there overall, okay? Today we have 325 earnings reports to be reported, but I'm going to keep this very short because, to be honest, there is no relevant company reporting anything with earnings today. And even if there was, I mean, I'm oversimplifying this, but to be honest, the news that everybody's going to be watching for today is not the earnings reports, is what's going to happen to SVB and other banks. And, you know, that's really the news, okay? Cool. So that's the headlines. Okay, now we're going to jump into live charts, okay? No slides. And we're going to be looking for trading opportunities. Of course, given the fact that the market it's very bearish today, I'm going to be very conservative on how I approach trading. So watch and feel free to ask questions. So far, everybody has been very, very shy on the chat box. This is not a very happy moment for me. If you guys remain so silent, I'm about to present a very nice trade idea, and then I will not know if you guys understood or not. So even if you don't take it live, which again, that's going to be your decision, as I said before, but for practice purposes, I would like to make sure you understand the mechanics around the plan I'm about to explain. So certainly I need your collaboration, even if it's only to say, okay, Jose, I got it. Just a quick okay will do. But I do need that from you guys, unless I get that, you know, it's really killing my motivation to share market opportunities with you guys. So if you don't mind me to be direct with you guys, hopefully you appreciate me being straightforward and just state what I feel, okay? Anyway, so S&P, as you can see, is falling down. Again, I'll come back to this chart later on. This is the S&P 500 index. I just want to point very quick at the fact that this gray line is way above the blue line. I will explain what this gray line means later, but that's a lot of fear in the marketplace. So in other words, I am expecting the market probably to show more violence to the downside, you know, later in the week, okay? The market is likely going to open relatively flat, 0.17% up is what we see on the futures markets. But again, there is plenty of fear in the market. We can see that from options data, which I will explain that better in a moment. Right now, I would like to focus on a couple of market opportunities. One is going to be with Caterpillar, which I have on my screen. And the other one is going to be with Goldman Sachs. So the Goldman Sachs trade, given the fact that it's a bank, is going to be so much more aggressive. And as you will see, the markets are intelligent, so it will pay also more, if right. But it's more aggressive. So this one with Caterpillar is going to be more conservative, but also, of course, it will pay less. Okay, so I guess it's fair enough. So what do we have here? So we have Caterpillar. Caterpillar is dropping aggressively, 5.79% down at this moment in time. So that stock is really pushing down aggressively. But guess what? At 199.58, let's call it 200, we have a green UFO. This is where the buy on field orders are. So guess what? The expectation is if Caterpillar was to drop all the way to 200, the buy on field orders will kick in, and that would potentially generate a turning point, and Caterpillar go back up all the way until where the sell orders are, 246. So potentially you could buy that stock at 200 and sell it at 246. Okay. Now, why did I say potentially? Well, because for that to happen, the stock needs to drop to 200, and the current value of the stock is 227. So what do you need to, what do you need to do? You need to wait, right? And while you wait, it may turn and go back up and never come back, right? So then you didn't make money while you waited, and then that was a waste of time. So what else can you do? Well, I'm gonna show you two different applications of selling puts, okay? So one thing you could do, given the fact that options are inflated in value, we are looking at CAT, Caterpillar, earnings are happening for Caterpillar on now. Why is not showing? Okay, now on April 27. So earnings are happening on April 27. Okay. So I could use an expiration date. Let's call it May. Okay, May 23. So I get the earnings reports priced in that option. So I'm going to have some nice juice built in the options contract. And from there, I'm going to be focusing on selling a put. Okay, which one? The 200. So again, not sure if you are aware of what happens when you sell a put. We had lessons and lectures in the past. You can look for it on the YouTube channel or in the Tiger Broker's mobile app as well. Those sessions are recorded in the past. But basically, you are being paid for your willingness to get the stock put to you. So if I sell the 200 put and the stock goes up, then the stock won't be put to me. But when you sell something, you get paid. So that premium paid, you keep it. So you will make money on some level of premium received. If the stock was to fall to 200, so then it's put to you. So now you own the stock, but you also keep the premium received, okay, which lowers your net cost basis. Okay, instead of 200, it's going to be less because while you bought the stock at 200, you got paid to buy at 200, which makes your net buying price to be less. So now your waiting time actually pays you in the form of premium. Okay, and if it goes up, you make the premium, and if it goes down, you get the stock at a discounted value because it's 200 minus the premium. Anyway, this is a crash course on selling puts. We talked about this in prior lessons. So if I do that, how much I get paid? So if I look at an option chain for Caterpillar, CAT, and I look at May 19, and I look at the 200, okay? So the 200 put is paying $4.50. So if I sell that option for $4.50, let me bring a calculator to the screen. So I'm going to make $4.50 of a stock that if put to me would cost me $200. I'm going to make that in 67 days, which is the amount of time to expiration. Okay, and if I repeat it, right? So I'm going to make that in 67 days. And if I repeat it every day of the year, meaning that every 67 days I sell a new put. So if I annualize my performance, so that is 12.25% rate of return, annualized rate of return, I should say. Okay, so if you sell it, okay, so no rules for entries and exits. Entry, no rule, exit, no rule. So you get an unlimited risk. Okay, why? Because if you get Caterpillar put at 200 and the company goes bankrupt, then you lose 200. But you get paid $4.50 for doing that. This is an equivalent of a 12% return on investment. Okay. Now this is option number one, which is a very simple application of options trading. You sell a put and you just wait until May expiration. That is May 19, by the way. What is another application, okay, which is a little bit more sophisticated? It will pay you a bit less, but it will have a great advantage if you are conservative. So instead of selling the 200 put by itself, okay, you could sell 2 of the 200 put, but you could also buy a put above, which the one above 200 is 210. Okay, so 210. So you could buy the 210 put, and then instead of 1, sell 2 of the 200. Because you buy a put of a higher strike, that's going to be costly. So even though you are selling 2, the net credit collected is going to be less than 450. Take a look. If I buy the 210 and pay 680, and then sell 2 of the 450, sell 4.5, sell 4.5, this gives me a net credit of 2.2. So I still receive a credit, but now my credit is 2.2. And 2.2 means that instead of making 12% return on investment, 2.2 on a $200 stock on 67 days annualized, that is 6%. So instead of 12%, my reward, my return on investment annualized is 6%. It's half. Okay, it's half. But what's the beauty? That's why I call this conservative. What's the beauty? Okay, so here the credit is 2.2. Okay, so what's the beauty? Well, if the stock drops to 200 and I sell the put, which is my first choice, and I get paid 4.5, so then my net entry price for the stock is discounted by 4.5. So I own the stock at 200. I got paid 4.5 to get it. So my net cost basis is 195.5. So I reduced my net cost basis to 195.5. Okay, that's case number 1. So you make 4.5. That's 12% return on investment. And if wrong, that's not the right way to say it. But if the stock drops to 200, you get it put to you at 195. So you get the stock at a discounted value. But this is the second case. Well, the second case is a bit more complex because it involves 3 contracts: buy 1 put, sell 2 puts, right? And in this case, if the stock comes to 200, you're going to make $10. So from 210 to 200, you just made $10. Okay, so your $200 stock is reduced by $10, bringing the cost down to 190. And on top of that, you had a credit of 2.2. So your net cost basis is 187.8. So instead of a net cost basis of the entrance of 195, if you sell the naked put, actually I should not call it naked, could be naked, but it's typically you would do this with a non-margin account. So it would be a cash secured put. So with doing the cash secured put, selling the 200 put, it would produce a 12% return on investment if it goes higher, or get you the stock put to you at 195 something. Well, if you do the most advanced application, then you get less premium, which instead of 12% a year is 6% a year. But if it gets put to you, instead of getting the stock put to you at 195, you get the stock put to you at 187, which is a much better entry price. And that's why I called it more conservative, okay? Because now you own the shares of stock and you own them at a better price. So that's what we've got here with this particular application number 1, which is Caterpillar. So I'm going to move to another stock now. Okay, I'm going to put this on the side here. Okay, I'm going to move to another stock, and we're going to do a similar application, even though I'm going to call it more aggressive, because the next stock I'm going to check is Goldman Sachs, okay, which is also a stock reporting earnings on April 18 in this particular case. Okay, so Goldman Sachs, April 18, that's the earnings. Okay, hopefully you made notes of Caterpillar. So now we are working on Goldman Sachs. Now, notice how the UFO here is nearer to price. So 316 is very close to the current price of the stock. And therefore, instead of using May expiration in this case, I'm going to suggest to use April expiration. So we're going to go nearer to the price, nearer in dates. So all of this is more aggressive, but also the stock is more aggressive because it belongs to the financial industry, which we know, based on what I said before, is now potentially in big trouble with what's happening to the banks, such as SVB. Okay, so now what can we do with Goldman Sachs? And once I plan it, then you may conclude it makes sense to you, it doesn't make sense to you. Again, all of those executing those trades are going to be 100% your decision. I'm doing this for illustration and demonstration purposes. And of course, you need to decide if that makes sense to you or not, for you to practice it with either real money or paper money, okay? But anyway, so we have Goldman Sachs. This is the option chain. Expiration date, I'm looking at April 21st. And in this case, we're not going to sell the 200 put because the UFO, it's pointing at 316. Okay, so I'm going to go for the nearest one, which is 315. Okay, so if I do 315, okay, the credit I'm going to collect for this trade, it's 10. So what is my return on investment on that? You would guess is more, even though it may or may not be more, because also the price of the stock is also more than Caterpillar. Caterpillar was a $200 stock. In this case, we are dealing with a $300+ stock. So we get more premium, but the underlying is also more expensive, right? So we get 10 out of being put the stock to us at 315. This is a trade that would complete in 39 days. So if I annualize it, so divided 39 times 365, that is a 29.7% of return on investment. So the trade is more aggressive, so you get paid more. Okay, now you want to make it a bit more conservative. What can you do? Okay, well, you could do the same thing I did before. So you buy a put at a higher strike. Okay, and then you sell, instead of one, you sell 2 of the 315. Okay, so which one is the higher strike? 320. So 320, oh, sorry, not here. 320 would be here. So you buy one of the 320 and you sell 2 of the 315. If you do that, so the calculator says that you would pay 12 and receive 10. So if I pay 12 and I receive 10, I pay 12.02 and I receive 10 twice. So this is a net credit of 798, which is less than 10. Right? So what are the consequences? Well, if the stock is put to you here, right, your net entry price, when being naked or cash secured, the 315 put would be 315 minus 10, which is a net entry price of 305. Now, if you do it with the most sophisticated method by buying the 320 and selling 2 of the 315, so you're going to make $5, which is the difference between 320 and 315, okay? But you will also keep 798, which is the difference between the strike prices plus the net premium collected, isn't it? So you would pay, remember the math I did before? You would pay 12.02, but then you receive 10 and you receive 10. So this is 7.98, which subtracted to 5 is 12.98, which added to 315, which is the entry price, gives you a net entry price of 302 instead of a net entry price of 305. So again, doing the below combination is more conservative, but of course you get paid less because the net premium would not be 10. The net received premium would be 798, which 798, if we annualize it, divided 315, that is times 365 divided 39. So that is a 23% annualized rate of return instead of a greater return on investment we had before, which was, I think, was 27, isn't it? 10 divided 315 divided 39 times 365, that was 29. So 29 versus 23, but also with a more conservative entry price. Okay, so in general, in trading, the more the risk, the more the reward, the less the risk, the less the reward. So anyway, here are the 2 trades for the day that I wanted to present to you guys for educational purposes. Hopefully this made sense. You appreciate these applications. Not sure if you have questions or you don't. But for sure, I would love to see, as said before, your confirmations on the chat box, so I know all was well understood, because obviously this is sensitive materials, and since the purpose of the sessions is to guide you into learning the use of options, And this is for practice purposes, for education purposes, and all of the above. When it comes to you know your stuff, you are confident of what you're doing. So asking questions to me would be a normal thing to happen. And certainly I'm watching those chat boxes, okay? So do not be shy and make sure you work with me on that. Cool. So what else? Okay, I'm gonna go back to the slides very quickly because I said I have a bonus for you. And to be honest, I forgot to highlight this on the screen. So here is my bonus for you guys. This is access to AutoClimate. I am about to use AutoClimate now in the market analysis I am about to perform. So you can have your own AutoClimate for TradingView. We charge for this, but by using this QR code, it would be free for you. So I welcome you to use this QR code, claim 8, so you can enjoy the same tools that we professionals use in planning our trades, that I definitely use. And you can have that on your TradingView, which, by the way, can be connected to your Tiger Brokers account. And then you can do not only the analysis, but also the execution from TradingView into Tiger Brokers. In case you didn't know, that's definitely doable. So with that said, we are now going to move into our SMARTT analysis, okay, the special market analysis report for Tiger traders. I'm going to move back to the last page here. So in case you need to take a screenshot of this QR code or the coupon code, or you want to see our social media handles one more time, so you have it all on the screen here. And now let's complete and perform our market analysis, which I'm going to conclude fairly quickly because the market conditions are very, very clear out there, as you will see in a moment. So what do we have? So first of all, on the left, I am looking at the SPY ETF in a daily time frame, and we can see this market is falling. But beyond looking at the candles, let's process market data through the use of intelligent technology, computers, AI, all these things. Obviously, can do things better than humans, and we love to use it for that kind of purpose, and that's how we build intelligent tools. Such as AutoClimate or Auto UFOs. We have patents on all of these things. And in this case, I'm going to be using AutoClimate, where here it shows in the format of colors, it shows what is the current market condition. And the current market condition, as you can see, is thick and red. Notice it could be thin and red, okay? Or it could be thin and blue, or it could be blue and thick, or it could be like today, red and thick. So we have 4 possible cases. And today it's red and thick. Thick dot, that means confirmed climate to the downside. Okay? Now, while we are in a confirmed climate to the downside, we don't want to be too scared, if you wish, because statistically speaking, the normal duration, normal means 1 standard deviation, the normal duration of climates to the downside in this time frame for this market is 3 candles at a time. We've been running 3 candles already on the way down, so we may be set for a change of climate, and if the climate was to change to become blue, then the normal thing to expect to the upside would be 6. So it's not like the world is ending, okay? But certainly, we are falling down, and it's confirmed, statistically speaking, it's confirmed that the price action, that the type of movements that we see in the market is not only that it's moving down, it's that it's moving down with a specific behavior that it's confirmed by the intelligent technology as confirmed. Now, the fact that we are reaching the statistical normal duration of a climate doesn't mean it's going to change immediately, because something normal means it's normal, but it's a 1 standard deviation. So sometimes you need to go for more of an extreme before you have a change of condition. You can see here how this red leg took more than 3 candles before it went back to blue. And by the way, the next blue wave, instead of 6, lasted less than 6, it was only 2. Again, probabilities and statistics are extremely useful as a reference, but we should always remember that that's only as a reference. It's not a guarantee of trading. Obviously, it's very smart to use statistical references instead of gut feelings, but keep that in mind, that the market could continue going lower. Now, something which is very much in our favor for the market to come back up, which is one of the reasons why I was happy to plan on those bullish trades on Goldman Sachs or Caterpillar, is the fact that the climate has extended up to 1.69, where 2 standard deviations of price extension is 1. So we've surpassed 1 by 0.69, which is over 3 standard deviations, which is, statistically speaking, it's statistically unsustainable. Now, unsustainable, it's a very big word. Again, statistics could be broken anytime. So the fact that it's statistically unsustainable obviously means that going short now is way too late, but the market could certainly keep falling until finally it turns. Okay. Now, going short now, it's definitely, in my mind, the way of how I trade is way too late, like way too late. Now, we didn't have confirmation for the climate to go from red to blue, so buying aggressively, it's way too early. That's why in my opportunities today, I didn't mention opportunities to get short aggressively or opportunities to get long aggressively. I was mentioning an opportunity to go long with a big buffer that allows for Caterpillar to fall all the way to 200, and you're still okay. You still make your annualized rate of return. Is that making sense? So I'm adding that buffer to allow me to be right on the trade because the climate is confirmed to go down, even though statistically, sooner than later, it should change direction. Okay. Now, I just said sooner than later, but it looks more it's going to be later than sooner. And the reason why is because of this line. The gray line is above the blue line. So what is the gray line? The gray line is the implied volatility for puts. And the blue line is the implied volatility for calls. So why is that relevant? Well, because the only way the gray line goes above the blue, the only way puts go above the calls is because there are more. Okay, there are more puts being bought than sold, and I just had a wrong keyboard combination. Sorry about that. So there are more puts, more puts are being bought than sold, or more calls are being sold than bought, or not figuring today, sorry about that, or both. And in both cases, more puts being bought is bearish, more calls being sold is bearish, and both is bearish. So we don't know if it's the first one or the second one or both, but all of it would bring the gray line above the blue. And that means, my friends, unless proving differently, we got sellers in the market. We had buyers in the market until that day, which is that day, basically, which is when the SVB news started to become public and created a great level of concern and fear in the marketplace. And now the sellers that were not showing up, even as the market was falling, sellers were not showing up. The blue line was above the gray. Now we have sellers show up with a confirmed climate to the downside. The two things together means that the market is likely to continue going lower. Now, it may need to bounce and go back to blue before it keeps going to red, but unless the gray line goes back below the blue line, it will be very difficult for the market to continue, moving higher. So we're going to have to watch for this. Of course, market conditions could change anytime. I mentioned later in the week we'll have inflation numbers. Maybe today, actually, some extremely positive news will be given related to the banks. And next thing you know, everything goes back to normal. You never know. Markets are dynamic, and we need to do our market analysis every day. It's not like you look at the market once a month and you bet on that and you never look back. Markets are dynamic, isn't it? So we need to look at this regularly. But with all of this said, that's what we have so far. And this is what it was a pleasure for me to present to you guys, both from an educational point of view with the trading opportunities, as well as from a commentary point of view now with the SMARTT report. So I will conclude the session today by getting back my slide on the screen. So you guys, if you missed it, you can have your own autoclimate type claimate, get that QR code. You can also get our book. Our book sells as low as $3.88 if you buy it in ebook format. You can also buy it in paperback. And the link is on the screen, isn't it? throwwithufos.com/book. And then with the book, you also have access to the UFOs, and also you have access to a trading course, which could be useful to you. So with all of this said, it's going to be my pleasure to say goodbye. By the way, I will see you in 20 minutes. If you happen to attend our 3D market commentary, which we do in a weekly basis, I will be the one presenting that market commentary. So you'll see me around in just a little bit. So see you in a moment if that's you. And if not, see you next time in the next Tiger live session later in the month. Take care, everybody. See you soon. Bye-bye.